Guys, it's Doc's Market Minute for Friday, June 5th. I'm looking at the fractal chart of the 10-year note, the TNX, and this is sort of a proxy for the interest rate of the 10-year note. So 24 value is like a 2.4%. And you can see that just over the course of the last month, we've seen quite a rise in this potential interest rate of this 10-year note, okay? So from about 1.9 up to 2.4, which is a pretty decent raise. And you can see just on the weekly chart how this has now changed polarity from a downtrend into an uptrend with a series of higher highs and higher lows, and is threatening to break above this longer term monthly trend line. So you can see just how rates have been falling for a long time, but with a significant higher low, that raises the odds that we're going to see a higher high. So what does this all mean to us? What this means is that with today's jobs report, which came out and didn't just hit it down the middle of the fairway, I mean, it hit it way over the green from the tee. We had 280,000 jobs, which I guess in today's new normal is viewed as a big report. Now, 10 years ago, that would have been a really mild report, because I think it takes an average of 300 to 350,000 jobs a month just to be able to hit that 5%, 4 to 5% GDP number that we're looking for. We're nowhere close to that right now. But again, this is the new normal. I mean, automation and technology are displacing jobs at a very rapid rate. And so that is kind of the mega trend that we have to look forward to. So anyway, without getting too far off topic here, it looks like rates are starting to rise, and the market is starting to anticipate that very, very unlikely that the Fed is going to raise the rates in the June meeting, which is coming up in a couple weeks. But that starts to raise the possibilities that maybe September or even December, we are going to see our very first interest rate hike. Now, I don't think this is going to be an extremely market negative event. If we go back to the last time that this happened, which was after the tech bubble burst, we started finally raising rates sometime around the 2004, I think it was June 2004 timeframe. And yeah, the market had a little bit of a negative reaction to that for a couple of weeks, but after that it would very quickly stabilized and said, okay, let's get on board. And I think that's the same thing that's going to happen now, is that we're going to be pins and needles looking at this silly interest rate hike, which may or may not happen for months and months and so. But before we get too far ahead of things, first quarter GDP was negative. So what's going to happen is late July, we're going to be looking at the second quarter GDP. We're going to get our first read on that. And if that starts to look like that is going to be negative as well, 2 quarters in a row of negative GDP equates to a recession, and this market is not priced in for a recession right now. So you can believe that the market will be on pins and needles over the next 6 weeks or so as we start to anticipate that number. That is going to be the most important thing that occurs over the course of the next 2 months. Okay, guys, that's it for today's Market Minute. Thanks for listening, and have yourselves a great weekend. We'll see you next week.